save our economy. We will rescue our middle class.
Together, we will build what I call an opportunity economy.
The world is closely tracking updates from the United States in the run-up to the 2024 presidential election. But the coming week will shift focus to economy from politics, and in the spotlight is the Central Bank of the United States, the Federal Reserve, which is set to announce its next monetary policy move on September 18th. From small stock market investors to large hedge funds, there is great anticipation to see if the US Central Bank will reduce its federal funds rate. But why is it so important? For the US, the federal funds rate is the interest rate that banks charge each other to borrow money overnight. It determines how much it costs to borrow money from banks for both businesses and individuals. Meaning, if the federal funds rate goes up, it's very likely that interest rates on home loans or business loans will go up, and vice versa. And as of now, this crucial interest rate is at a 2-decade high. It has been kept that way for more than a year. Now every market analyst says that it is time the Federal Reserve changes course. A recent Reuters poll of economists found that a majority of them expect the US Central Bank to reduce interest rates on Wednesday. And this optimism is not unfounded. Even Federal Reserve Chairman Jerome Powell has hinted towards this action. In his recent speech at the Jackson Hole Symposium in the US state of Wyoming, Powell said that the time has come for policy to adjust.
The cooling in labor market conditions is unmistakable. Job gains remain solid, but have slowed this year. Job vacancies have fallen, and the ratio of vacancies to unemployment has returned to its pre-pandemic range. The hiring and quits rates are now below the levels that prevailed in 2018 and 19. Nominal wage gains have moderated, and all told, labor market conditions are now less tight than just before the pandemic in 2019, a year when inflation ran below 2%. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions.
While US businesses and citizens are hopeful for some relief in loans and mortgages, the world is also watching. Why? Any decision by the Federal Reserve has drastic ramifications for the whole world. The US is the world's largest economy, and its currency, the dollar, dominates world trade. Additionally, the US plays a key role in providing loans to the rest of the world. When the Federal Reserve raises interest rates, borrowing costs surge worldwide. For emerging markets like India, Brazil, South Africa and others, their currencies weaken, imports become costlier and inflation rises. And when the Federal Reserve lowers interest rates, borrowing costs worldwide decrease. As the Federal Reserve is on the cusp of reducing its federal funds rate, let's try to understand how US actions after the pandemic impacted the world and what its positional move would mean now. Central banks around the world use interest rates to tame inflation. The Federal Reserve did the same in the aftermath of the COVID-19 pandemic. The pandemic led to a sharp rise in consumer prices. This was because the lockdown put a constraint on the supply of goods. At the same time, government cashing checks to people and businesses led to a sharp rise in demand. By mid-2022, the US inflation rate rose to a level last seen during the 1980s. This prompted the Federal Reserve to start raising interest rates. Before the pandemic, the federal funds rate was nearly zero. Between March 2022 and July 26, 2023, the Federal Reserve raised the interest rate 11 times, taking the federal funds rate from nearly zero to over 5%. The country had last seen such high interest rates in 2007. After that, there was a long pause, during which the country saw its inflation rate come down. And as of August, it has declined to about 2.5%. However, this tightening of monetary policy has also had significant side effects for the country's economy. In the second quarter of 2024, the US job market saw this play out. Between May and July, the country's overall employment consistently declined. When the July jobs data came out, the stock market was rattled. Some raised concerns that the US economy might fall into a recession. While that fear has receded, officials at the Federal Reserve started talking about an interest rate cut.
If you look at the Federal Reserve, they are data dependent, right? So by definition, that means they're going to be backward looking and late to the party. Once again, we're finding out that they're late to the party. If, in fact, they cut by 50 basis points or more in their September meeting, I think that sends an alarming message to investors that this economic slowdown is now gotten much ahead of what the Fed anticipated and could lead into a potential recession.
Any decision by the Federal Reserve has a multifaceted impact on the rest of the world. It affects other countries' borrowing power, trade costs, as well as foreign investments. First, let's talk about foreign investments. When interest rates are high in the US, big investors like large investment banks, sovereign wealth funds, hedge funds, and others prefer to keep their money in the US as they receive higher returns. They also invest in US Treasury securities, which is a debt-raising tool for the US government. It provides higher returns when interest rates are higher. This also leads to slower debt inflow to other countries. According to an IMF report, recent monetary policy tightening reduced debt inflow in emerging markets and developing economies by as much as 70%. 26 out of 75 countries saw investors pulling out their money. Another impact was on the currencies of emerging markets. The sharp increase in US interest rates also pushed the value of the dollar compared to other currencies. Since 2022, dollar has been on an upward trajectory. It declined slightly in 2023. This also pushed the cost of trade for other countries, as other nations have to pay more to buy any goods or services in dollars. It also makes it difficult for them to repay debts. This has especially impacted low-income countries like Egypt, Morocco, Lebanon, Pakistan, Tunisia, and Zambia. As the Federal Reserve prepares for interest rate cuts, analysts believe that emerging markets are bound to benefit from it. Lower US interest rates could attract capital inflows to these markets. It will also boost their currencies and stock prices. That is because investors would move to these markets seeking higher returns. According to a report, India and Brazil are two markets that are bound to benefit from the Federal Reserve's decisions. India's stock market has delivered over 16% gains in the past year. This kind of return already makes the country attractive for overseas investments. Meanwhile, analysts cite recent budget cuts and tax reforms in Brazil that make the country more attractive. As anticipation grows for the Federal Reserve's announcement, financial market stakeholders will be carefully watching how foreign investment inflows in these countries change. So whether the decision is to cut rates or hold steady, we know its implications will be felt across the globe.